prohibited transaction rules is one of the most important topics that I can discuss with my clients. But when it comes to prohibited transactions, usually the first question I get back from my client is, well, what's my audit risk? If I do something bad, which I say, well, you're not going to do anything bad if you work with me. But then they say, well, let's say I do screw up. Well, what's the deal? Is the IRS flying drones around? How are they going to know that I'm living in the house my IRA owns? How are they going to know I'm hunting on the field my IRA owns? How are they going to know that I'm using my Bitcoin to buy a car I drive? How are they going to know that I'm doing a hard money loan to my son? The question is, well, it's a bad question because you should never do a transaction and play the audit lottery. At least if you work with me, I don't want to work with you if that's your attitude. But that being said, basically, no one knows the IRS, what triggers an IRS audit. Anyone who says they do is lying because no one knows. If the IRS told us, then we would be able to protect ourselves from IRS audit. We don't know. Most people in the IRS don't even know what triggers an IRS audit. So I hate when people say, well, if you do this and do that, you're going to protect yourself from audit. We don't know. The IRS actually does provide information on 401ks in terms of audit numbers, which is very interesting. They don't give us anything on IRAs. So with a solo 401k, for example, less than 0.25% of plans get audited that file 5,500 EZs. With IRAs, I don't even know. I would say it's less for a number of reasons. About 50 million IRAs out there. I'd say about 95% are doing traditional investments like stocks, mutual funds. The chance of you doing a prohibited transaction with a traditional investment like Google or Apple stock is zero. So that being said, when an IRS agent goes to an audit, there has to be some economic potential in that audit. For them to spend a certain amount of labor and time through an audit, in order for them to not get fired for doing so, they need to show that time has been well spent. So if they spent 4 months auditing your $20,000 IRA that was invested in Apple stock, it's probably not good use of government resources because the chance of them finding anything is zero. Whereas if they spend 4 months auditing IBM, that probably makes a lot of sense because you got $1 billion corporation and maybe a deduction here, a deduction there can generate millions of dollars of tax revenue for the government. So that's what they look at. There's also a public policy point here too, is the IRS is not interested in blowing up people's retirement accounts. You may think so, you may, big bad IRS, but I've worked with the IRS. I have a lot of friends that still work at the IRS, and they're good people. They have to do their job, but they're not out to get people and screw people's life and make your retirement account less successful because they want to, but they got to protect the rules. So if you screw up on its face and you violate 4975C, they will nail you. Okay, they will. I don't know what the chances are they'll find you. Me nor anyone can tell you. Anyone that says, hey, if you do this or do that structure, if you do the checkbook control, if you don't, you have a better chance or a worse chance of getting audited. No one knows. Prior to 2015, 5498, which is the form the custodians submit to the IRS, didn't even have the type of investments the IRS or IRAs made. All they had was the value. Starting in 16, you now have to say whether it's invested in real estate or an LLC or different categories. It doesn't give you the exact type of asset, but if it says invested in an LLC, that's what they'll know. So we'll see. Maybe the 5498 in some way will let the IRS know where they should go auditing. They claim the reason they asked wasn't an audit play, was to get a better idea of how many assets are in alternative assets. So they're concerned about valuation. The IRS is only concerned about tax revenue. The only thing they care about. So they're concerned that when someone hits 70, if they have their assets in private placements, they can underestimate the value of that IRA so that their RMD would be less. That's what they're concerned about. That's all they care about. They care about tax revenue. So they claim that the only reason they changed the 5498 form was to make sure that people weren't providing inadequate valuations to the IRS. and thus reducing the amount of their RMD. We'll see if it's an audit play. I don't know. I doubt it, but we'll see. The IRS audits, I've been through a few, and basically the one horror story I have is I had a client that had 500,000 plus IRA, and he screwed up. He wrote a $500 check from his IRA LLC to himself because the entity he owned had a very similar name to an entity a contractor owned, which he was not related to. He screwed up. The IRS found out 4 years later, and they blew up his IRA tax. No penalty. It was over 15.5, but they did blow up his IRA, and he had to pay tax. So audits could be painful if you break the rules. If you work with me, I pray you listen. If you listen to me, you won't break the rules. Again, it's self-directed IRA, so you could tell the custodian to send the money to an LLC, and if it turns out the LLC is, then your father comes in and invests in the LLC. We may never know about it. Basically, if you want to do something bad, you probably can get away with it, but you better watch out for an IRS audit, because if they find you, they will punish you, they will tax it, they could impose penalties of up to 100%, and they can make your life live in hell. So be careful. I can't give you the audit risks or rates or percentages. I could with a solo 401k, because that is available. Even with 401ks, defined benefit plans, even with 990Ts for filing unrelated business taxable income, there is information out there on the IRS site. Unfortunately, nothing for IRAs. But again, there's 50 million IRAs, 90% or so are doing traditional investments. The chance of them finding anything, how many people are doing privileged transactions? I don't think very many. So again, it's not a hot IRS thing. It's not like an S-corp wage, home office type thing where they can generate significant revenues and stop people from taking deductions, which would increase tax revenue. IRAs, people aren't paying tax anyways. The only thing they're worried about is undervaluing the IRAs, which could impact RMDs. So other than that, just be careful. If you are concerned about a transaction, don't do it. Don't play the audit Russian roulette. If you lose, it's bad news. So I hope my clients are watching, listening. Please, please, please. If you have questions, talk to us. There's great stuff in the IRA Center about privileged transactions. Learn the rules. If you have questions, call, complete the information at the IRA Center. Someone will talk to you and get you going and make sure you understand and can navigate the privileged transaction rules, because being involved in an audit when you screw up is not fun. Trust me, I've been there, and you want to avoid it at all costs.